So where is the national recovery? What is the probability of entering a new recession? For the last 2 years, we've been talking about what is going to happen. Are we going to have a double-dip recession? So the probability of a double-dip recession started the year at 31%. It fell to a low of 16% in July. However, it ended the year up a bit. Again, what was happening in December? These weather effects we talked about and arguments over the debt deal. So, when this comes out in about 2-3 weeks, I think it will back down under 20. What happened in the year? We had real GDP growth. So again, this is the probability that we'll be in a recession. So it started the year high, went down, tracked back up with political uncertainty and weather effects. What happened with real GDP growth? We started the year relatively weak. The good news is when I gave this presentation last year, the fourth quarter figures were actually negative. The early output figures were that the slowdown in federal spending had actually put us into a quarterly drop in output, in real GDP. But as you can see, output strengthened and then slowed in the fourth quarter. And what is driving this is really government spending has been a negative influence on GDP growth for 5 of the last 8 quarters in the last 2 years. So really the private economy is doing well, expanding rapidly. Not rapidly, but expanding at least, but the government has been a drawdown. Again, the good news has been through last year, through 2012, it was state, local governments and federal governments that were causing declines in output growth. Now it's really just the federal government. State and local governments seem to have at least stabilized at the national level. Where was the national economy last year? Red is in recession, yellow is at risk, blue is recovery, green is expanding. Last year, as you can see, much of the nation was recovering, with some places at risk, and your energy states expanding. Now you have broad kind of expansion in the Midwest. I'm trying to figure out what happened in Massachusetts because I'm doing some work in Maine, and their economy has really picked back up. But again, just a recovering national economy across the board. Where is the national economy going to be? We have an accelerating recovery coming for this year. We have 3 to 4% real GDP growth. I think more than 2% employment growth nationally. Limited inflation in the near term. I know people have asked me what's going to happen with inflation. I can talk about that later. I think in the long term, we're going to have some inflationary pressures as the economy recovers. But in the near term, there's predictions for more or less very low inflation. Continued housing recovery, firm profits. We're finally seeing what's happening here in terms of expectations for pay increases. The blue are, the orange is low-income workers, blue are middle class, yellow is upper income workers. And as you can see, very few people expected, except for the rich, expected increases in salaries. It's finally trickling down to the bottom of the economy. So again, we have a good, stable recovery going here. However, federal fiscal policy will continue to be a drag. The question is how much. If we do significant budget cuts, if we agree to these, that will drag the economy down. Domestic and political uncertainty remains, and things have been all over the board. When you look at the economic indicators, there's been a great deal of volatility. Things are going up and down, not really trending in a stable way. So there's a lot of volatility, but again, I think a stable and continuing recovery. Kind of any questions about the national?
Just had a quick question. I know you said the folks at the bottom income scale are slowly seeing an uptick in their
expectations for wages.
Expectations. Does that? Do your assumptions include the conversations on the increasing of the minimum wage at the national and state level, or?
Yeah, I'm sure that factor. This is a survey of people by income. We've been debating the minimum wage increase for a while, so this could simply be a political response. It could be. I think 2 things are going on. One, labor markets are tightening. So there are more demand for workers, so people don't feel scared to ask for more money. I think 2 years ago, especially at the lower end of the skill range, I think you were crazy to ask for a raise. But in the near term, 2 things: slightly tightening labor markets, and expectations for minimum wage increase. Any other questions? National economy. Well, the Maryland economy. What the next 3 charts do is look at Maryland, Howard County, and the United States. And again, the general trend here is that when you look at unemployment rates or any of the indicators I'm going to throw out, Maryland has, Howard County is doing great. Our unemployment rate, Howard County is green, is much lower. Maryland is lower than the national average. So, for the last, almost 12 years. We've done far better in terms of unemployment rates.
Richard, that's just through September. Through December, the rate in Howard County actually fell to 4%. So it continued its downward trend.
In employment growth, again, the same thing. Howard County has done better than the state and the nation, for much of the last 10, 11 years. What's interesting here is Maryland did not benefit quite as much from the economic expansion in the latter part or the earlier part of this decade, but we didn't fall as much. But again, we're kind of trailing the recovery. So Maryland is doing a little bit worse than the nation as a whole in terms of employment growth. Howard County, again, doing quite well. Same story for personal income growth. Howard County doing great. Maryland not sharing quite as much in the gains or the pain, in the pre-recession, in the pre-recession expansion during the recession decrease. So again, what we have here is Howard County doing great, state of Maryland doing good. Better than the national average or trending towards the national average. Why was Maryland doing well? Why didn't we have the recession that Detroit had? Why isn't Baltimore in the same line as Detroit here? It's because of our reliance on federal spending. I looked at federal spending 3 ways. So you look at federal, civilian, and military employment by place of work. So this is where you work. This is so do you employ at NSA or some other type of agency in the state? I looked at employment by place of residence. As you all know, plenty of people who live in Howard County drive to the Pentagon, drive to Washington. Plenty of people in Montgomery and Prince George's County drive into Washington, and they work for the federal government. So again, when you look at federal employment, it's about 6.5% of our employment base, 5th highest in the nation. When you look at people who work for the federal government, it's 10.5%. In Maryland, this is the 2nd highest concentration after the District of Columbia. And when you look at federal purchases, so these are 2012 figures, these are 2013 figures. Federal procurement is federal purchases of goods and services. The federal government purchases $23.3 billion worth of goods and services in the state of Maryland. That's about almost $4,000 per person. So that is why we didn't have quite as bad a recession as the nation. But that's also why the recovery is trending down. As I presented earlier, the federal spending has been a drag on the economy. Federal spending isn't increasing as much. Those of you who read the Post yesterday saw that the figures in December that were released for federal procurement database were actually down about 15% for federal procurement activity. So that's why we didn't have a bad recession, but it's also what's slowing down the recovery.
And those numbers do not include NSA purchases.
I was going to get there when I got to Maryland, or got to Howard County. So again, what is the forecast? We have 2 forecasts here. This is the Maryland Board of Revenue Estimates, which is kind of like the Spending Affordability Committee. They tell the state what the economy and what the spending should be. And you have Moody's, which is one of the largest regional consulting firms, fiscal consulting firms in the nation. Generally speaking, the Maryland Board of Revenue Estimates is a little bit more pessimistic than Moody's. Last year was the exact opposite. Moody's was a little bit more pessimistic about Maryland than the Maryland Board of Revenue Estimates. But both of them, Board of Revenue Estimates is predicting 1 to 2% growth. Moody's slightly higher. Personal income growth of 4.6 and 5.1%. Moody's a lot more robust here in terms of 6 and 7% in the next 2 years. And then the unemployment rates are falling under both, and with Moody's having down below 6 in 2015. So again, this is where the forecasts are for the state's economy. Kind of any questions about that? All right, how is Howard County doing? As those first 3 slides is that we're doing quite well. And again, all these slides are in the report which was handed out. When you look at population growth, Howard County is the I think 4th highest in terms of percentages. The 4th highest in percentages, 5th highest in terms of numbers of population growth. So we're growing in population. When you look at employment growth, and this is all jobs, when you look at the pre-recession, from the 2001 recession to the 2007 peak, we grew at twice the rate of the national average, or excuse me, of the state average, and we are only one of 4 counties that have recovered our employment from the pre-recession levels. And what's interesting here is what are those 4 counties? Anne Arundel, Howard, Hartford, and St. Mary's. What's happening there? These are all what? Base, these are BRAC, Hartford and Anne Arundel and us are impacted by the last BRAC, and then St. Mary's with the Pax River BRAC, which was 10, 15 years ago. So again, these are the government-related counties. When you would take out government employment, this includes government employment, only 3 counties, but again, St. Mary's, Hartford, and Howard County. So our economy is doing relatively strongly. We have slide got dropped.
Okay.
But the Howard County residential real estate market. So the employment and population growth, those are what drive personal income growth. That's what drives, about half of our tax base. What's the other part of our major tax base is the real estate market. So what you have here is, again, significant signs of recovery. The blue is units sold, the red is active inventory, green is median sales price. The median sales is on this axis, these units are on this axis. What you see here is in the recession, we had this massive increase in active inventory and decrease in units sold. Since the recession, we've had pretty strong recovery in units sold. The active inventory has declined, and the median sales price is trending towards pre-recession levels. So real estate seems to be in recovery, and this is even more evident when you look at new housing units authorized for construction. This is just for the first 10 months of 2013. So you see, we're up to the levels we've last seen, in the year 2000, 2000, 2001. So the housing units authorized for construction, this really is a sign that residential real estate is recovering. And that's a good sign because property taxes are the other major part of the Howard County tax base. So we seem to be in a real estate recovery that's also extending somewhat towards non-residential. Data from the Maryland Baltimore Metropolitan Council has us going from under 70 million, about 70 million 2 years ago, to a little bit over 100 million in non-residential construction activity, so commercial buildings. That's lower than it was pre-recession, which had hit about 200 million a year. So again, broad-based real estate recovery. One of the other things that's driving Howard County is in-migration. Unfortunately, these numbers have not been updated by the IRS for the last 3 years. But again, what you'll see here is that we have net in-migration of people, and those people tend to have higher incomes than the people who are out-migrating. So again, because of Maryland's or Howard County's strong quality of life factors, our real estate market's doing better, and people moving into the county tend to be higher income than those moving out of the county, which again is a good sign. Oh, here's the slide that got messed up in order. I apologize. What else is going on in Howard County, and this is this question about federal procurement, is we looked at the private non-farm employment by sector. So these are these NAICS code sectors. So these are broad-based sectors of the economy. We have what's our employment now. We have a location quotient. What a location quotient measures is the concentration of employment in an industry. It's simply the share of employment in that industry compared to the national average. So if you have exactly the national share of employment in that industry, the location quotient is 1. What this measures is concentrations or specialization in an industry. So if you have a location quotient of 1.2 or above, you're considered to be specialized in that industry. So that's what you do. That's what you export outside of your state or county economy. If you have an LQ of less than 8.8, that means you tend to import that activity. That means it's an industry that you can grow to meet your local demands. So what's really, and then you have employment growth. And again, what's really interesting going on here is Howard County, even in this recessionary period, is gaining a substantial amount of jobs in professional and technical services, management of companies, education and healthcare services. These are all very high income jobs. What you see here is that in the last about 5 years, our professional and technical services sector has grown 40%. And what's driving that is BRAC in procurement, which I'll go into. And when you look at the concentration, we have about 3 times, 2.99. So that's 3 times the concentration of employment in professional services than the national average. So that's what's really driving the economy. What's also interesting here is when you look at things like retail, we have an LQ of 0.87. When you look at accommodation and food services, 0.76. That means we have a relatively underdeveloped, retail sector in Howard County, which is hard to believe with all the stuff you see around. But this is a good sign for the fact that we're redeveloping downtown. What this means is that there is demand for these types of services to serve our affluent population. What's the Howard County, what is driving this Howard County economy? This is federal procurement. What you see here is this is federal defense and non-defense procurement from the fiscal year 2000 to fiscal 2013, increased more than fourfold. So that is one of the things that's driving Howard County's economy. Now this is calendar year figures, because I think it makes more sense to kind of show what happened in the calendar year. What is the federal government, and as Ray pointed out, this does not include NSA. NSA is prohibited, does not release, and CIA also. So certain Cyber Command NSA purchases are not listed in this federal procurement database. So this is unlikely to tell the whole story in Howard County. What this also says is, what does Howard County sell to the federal government? You know, who are major procurement contractors are Johns Hopkins, APL. This is a big construction project. But again, IT and consulting services, when you look at them by what type of industry, 68% of what the federal government buys in Howard County is business and professional services. $700 million nearly of R&D services, 43%. So what does this mean? We have a large base of federal employment. One more slide. Other strengths, and these are slides 14 through, or 8 through 14, starting on page 20 in the report. I didn't want to put all these slides up. What else is driving the county? We have one of the most highly skilled and educated workforces in the nation, in the region. We have I think 60% of our population has an advanced degree, a bachelor's degree or above. 30% has an advanced degree. That's the highest in the region, or among the highest in the region.
And actually, that is the highest in the country.
So we have, now the employment here is one of the things that's interesting is this is concentrated in health and education, business and professional services. Washington is a business and professional services town. Baltimore is a health and education, meds and eds town, where we straddle those two regions. We send people, both of those are high income types of jobs. We straddle that region. We send a lot of people north to Baltimore for health and education and south to Washington for federal government, business and professional services. And we have a high degree of out commuters. We're about the fourth highest in the state in terms of people who leave the county. And again, that's good for economic development in some ways, because what that says is you have an active workforce that you can try to attract. Everybody would rather work close to home than fight Route 32 and 95. So one of the things you can do is market that in terms of your economic development and say, come here, we have workers who are leaving to get jobs, and they'd rather stay here. We have an expanding local employment base, and 13% work for the federal government. So why am I, given this decline in federal spending, why am I not pessimistic about Howard County? Two things. Of those 13% of the workforce that works for the federal government, according to Kent Menser's figures, about a little bit over 60% of those work on Fort Meade. And again, why this procurement base is quadrupled in the last decade. So why am I not worried that that is going to be removed? Because again, what are we selling? Likely to be selling a lot of stuff to Fort Meade, Cyber Command, and these are the types of things that are less likely to be cut in the near term by the federal government. Long term, all bets are off, but in the near term, I think this is not going to be a downside on the Maryland and the Howard County economy.
Can you comment on what the fourfold increase in defense spending is? That number, I'm in that industry, that number surprises me. What's driving that?
I could run it, but I don't have it run. It's business and professional services is what is driving it. So, you have companies like Impact is a company, it's small, it's only $30 million, so don't get me wrong, but that didn't even show up in the database 5 years ago. That's a local company I've read about, but this is a company that's gone from relatively small sales. So I think we've also had in-migration, SAIC and other types of firms moving into the county. So I think there's been a variety of things going on here. Growth, native growth. APL has built, 3 more buildings in the last...
But you don't believe it, I guess the fundamental question is, you don't think it's transient? In other words, they're not building buildings and they're going to be done in a year? You think is that number going to stay steady? Or?
This is the construction, is really this, which should probably be removed, but it's in the database. All the other things are professional services. Okay. So yeah, is some of the architecture and engineering related to construction? Probably, but it's only that's architecture and engineering And that's including all engineering. I mean, so again, no, I don't think in the near term, and remember that NSA purchases, certain national security purchases, like for Cyber Command, are not in this. So if anything, that understates what's happening. So what's happening? Native growth at APL, firms moving into in the region, BRAC firms not locating in Anne Arundel County, some of them locating here.
I think we've come to understand the NSA building program is multi-year. I mean, we're talking over the next 10 to 15 years for the building program that they've let out for construction on that campus.
So, and then one of the worries that came up when I gave this presentation was that last week to the Economic Indicators Committee is what happens if they start developing property on Fort Meade like they have started to do in Aberdeen. So that is something that is a risk factor for the county. Nobody can really predict how much, and you know, some people were very worried. Some people said, "Ah, it's never going to happen." So I can't answer that one. So again, for all these reasons, I am not pessimistic about the Howard County economy. I'm predicting for fiscal 2014, just under 5% personal income growth, expanding to over 6%, and again on a calendar year basis, over 6% for the next 3 years. You know, these are back to levels of the mid, early part of the decade. So kind of any questions about Howard County? Did I go too long? Or?
No, you did fine.
Richard, a quick question.
I told you no hard ones.
Why don't you
This
go
is a
back?
very easy one. Now,
Go back to the previous slide.
do you have any numbers on the inflow in Howard County, population inflow, and in state of Maryland? Is it-
No, the best figures for this are these in-migration tables. The IRS Statistics of Income report used to annually produce from your tax returns where you moved. That data has not been released since I gave this presentation in 2011, I believe. So they found a glitch in the software, and they have not released this data since 2009, 2010. You can look at this through American Community Survey data, but that is estimates, and it's not accurate. I think when you go to the housing market, when you go to these types of figures, it's very clear that Howard County continues to attract people. Our population is growing, or our real estate wouldn't be recovering. And the people we're attracting tend to have higher incomes because they wouldn't be able to afford houses in West County or Maple Lawn. Or these are not inexpensive places to live. So I don't have good figures. You know, if I'm lucky enough to do this again next year, those figures will hopefully be out because they've had the same.
Yeah.
So they're going to release several years worth of data once they fix the glitch. But again, these are the best data. They're not, they have not been updated for a while. These reversed. For the previous 2 years, we tended to have a slight outmigration of population, and we tended to have slightly lower income people. That might have been a wave of retirements. I don't really know.
Yeah, because I believe that is a very important indicator, economic indicator, that we are missing out on.
So.
With all the growth going on, one interesting data point, in 2012 you're showing 61% of the population's white, and poverty was 4.5%. The school system now has a majority minority student population, and farms is approaching, free-reduced meals is approaching 20%. So, while there is all that growth, we're serving a much larger, needier population, at least in the schools.
Yeah, clearly that's driven partially by the recession. It's also, the broad population tends to be older. We could be attracting younger people. But clearly, with Columbia's diversity goal, you have more opportunities for housing in this county. For the highest, the fourth highest income county in America, you probably have more opportunities for housing of persons of middle and lower income means than in similar high income counties.
Richard, when Jeff Brownell made his presentation a couple of weeks ago, he talked about how in the general plan that over the next 20 years we'll be building less single-family homes and more multifamily homes, more townhouses and condominiums. Is that going to have an impact, I guess, on Howard County personal income and/or school populations? That's and the question we debated last week was how many school children are going to be moving into downtown Columbia because of the massive redevelopment there, or will those likely be childless people?
I think there's been a change in real estate preferences towards a more urban style of living. So when we looked at this for Charles County 10 years ago, and Charles County was building large numbers of townhouses, we looked at the issue of do townhouses pay for themselves? And the answer then was a little bit worrying. I think that's changing. I think you've had a change in preferences in terms of people looking for a more urban environment to live in. So places like Maple Lawn are more attractive. So when we're building attached homes that look like Maple Lawn, and I don't get any money from that company. I go there to eat at Ranzoul. But so the question is, geography. This area is getting full. Real estate-wise, we have less land to develop, especially in places like Howard County. So the move to attached homes doesn't worry me in the least. The fact that so many of the units for downtown Columbia are rentals does bother me a little bit. So the question is, are they going to attract higher income people, who would otherwise move to Florida and want to live in an urban, older people, or are they going to attract younger people? I think with this, they're going to attract a mix. It's probably going to be this issue of, if you look at condominium developments and attached homes here, I think they're generating more children than they do, than was probably predicted. So I think the impact is, the attached homes bother me not at all. The condos and apartments bother me a little. They tend to attract a lower income residents.
What have you seen with school generation numbers? Have you seen changes in those, or is it?
Yeah, we've seen I'd say a significant upward trend in the generation rates. It's not totally consistent across the county, but we are seeing more, especially along Route 1, I think, where more than we had traditionally seen coming out of those kind of residences.
More kids in smaller houses.
Yeah.
What's the break even when taxes, like you have to, what's the break even?
Well, we haven't done that analysis for a couple of years. It used to be it took a relatively high value single family home to break even, but I think when general plan stuff was done as much as 10 years ago, they basically said residential development right now pays for itself.
Oh, good.
That's what, I'm sorry Jeff isn't here today, but yes.
Yeah, I'm just, I was over, go ahead.
Oh, I was just gonna ask, when we're doing that calculation, are we looking just at property taxes or the county income tax as well? 'Cause
Property income tax as well.
Okay.
All of the services provided and all of the revenues collected by the county, which are prominent, as we've learned, are income tax and property tax.
The way these studies are typically done is you look at, you develop a profile of people by housing classification. You then look at what the likely property taxes, likely income taxes of those people are. You then take your consolidated annual, what's the CAFR stand for? Consolidated annual
Comprehensive
annual financial report. You divide up, you allocate things like police, school to a household level. Then you say, how do these match up? I think in Howard County, because the high income here, you're unlikely to find that I think most residential development, which is unlike many other jurisdictions, I think most residential is likely to have paid for itself. The question is, do the future pattern of development of more apartments, that's too hard to predict.
Are someone looking at that and gonna develop a number, or?
Not at this point, we're not, but it's something we can look at.
It's something we should do.
Yeah.
I was always, this goes back, it was 400 and some thousand, that along 6-8 years ago, last time I heard that number. And then also, what's the commercial assessable base percentage-wise?
Of the real base, about slightly less than 20% is commercial industrial.
And is there a target we have as a county?
Well, for many years we chased that percentage, and the problem is during the last decade, even though the value of commercial real estate continued to grow, residential real estate doubled.
Right.
And so the percentage that was commercial industrial went down.
Right.
That didn't necessarily indicate a declining business base, it just indicated that the residential base was growing faster. And I think we've adopted more of the concept of jobs as a measure of the health of the commercial base rather than the commercial assessable base. As an indicator, residential reassessment this year went up 8% over a 3-year period, and it was what, I think, 17% for commercial real estate in the last reassessment cycle.
It's just the commercial development in theory puts a lot less stress on the infrastructure.
Right, and we're continuing to do that, but in terms of measuring it as a percent of the assessable base,
Right.
it's an unachievable goal because the residential base grew so fast during the last 10 years.
And we're entering, there are phases of suburbanization. I mean, the first phase of suburbanization is that people move to suburbs. Second phase of suburbanization is retail. Personal services moves to suburbs to serve the people that used to live in the city that now live in the suburbs. The third phase of suburban development is development of suburban employment centers, or edge cities, which a Washington Post writer talked about. And that is where, Howard County is clearly emerging into that in terms of a developing employment center as an employment center in its own right, with Gateway and BRAC and possibly Route 1. Those are the types of things that happen. So as you enter that third phase, your commercial base increases because you're building more office. So we're entering that phase, which is, again, a sweet spot for the county.
Thank you.
Thank you.
Change places with you? So the question that we've been listening for the past, I guess, 6 weeks now to a lot of presentations about the outlook in the economy, the need for spending. I guess the real question is how do we use that information, and how are we going to kind of reach conclusions about what is affordable? And what happened to my... There it is. Okay. So this is the model that I mailed out to everybody a couple of days ago, and it has a series of assumptions. And so we need to spend some time talking about what those assumptions are and how we're going to set those assumptions. I just arbitrarily set these at 3% other than the ones that I'd set lower than 3%. The question is what are valid assumptions for growth in education, growth in our police department, growth in other agencies? Primarily, as you see, we're driven by education and police. And the amount of bonds that we're going to authorize, and then what is going to be our growth rate in income tax and property tax and other taxes, and what interest rate are we going to use to project bonds. I've dropped in for 2015, I think you can see $120 million. And as you look at the bottom line here, you can see that it's showing that in 15, I have expenditures growing at 3.7% and revenue growing at 3% going forward. That's generating, because of the surplus, a $24 million difference, positive difference in revenue. With these assumption numbers, as you go out into the future, you can see at this level, by 2019, we're pretty much at the break-even point. So we have to go back and to the top, and let's talk about what we think. Let's start with revenues first. And so I would tell you that I think for property tax that 3% is a good number. Given the information we've gotten, given the sense of where property values are going to go. And remember, 3% a year because of the phase-in is closer to 9% over a 3-year period when properties are reassessed. That adds in new construction as well. But 3% is what we've projected growth for this current year. And then the question is whether we think growth is going to accelerate. I would say we have about 10, 15 minutes left on that battery. And I'm recharging the battery down here, so we'll see how far we get with that second battery. We get about 45 minutes from a battery and then it dies. So the question then, the real next question that maybe we have to think about is growth in income taxes. And as I think we've seen from the past year, our income tax has been growing a lot faster than 3%. And our income tax is driven primarily by growth in personal income, which Richard says is going to be an awfully high number, close to 6%, 6.5%, at least over the next 3 years. And you don't see that. It's hard to project out into the future. But it's hard to, I'm assuming you don't think that's going to change dramatically from
we're in a recovery period,
forward.
so it will slow, it will moderate, but it won't drop. So, no.
And then, of course, the other factor that I've talked about that drives income tax is the unpredictable capital gains. Because in years when capital gains are good, we're going to grow faster than 6%, as we have over the past couple of years. And then when capital gains drop off, we grow slower than the personal income rate. And so the real question is what is a reasonable growth rate do we think is that we can project? I think 3% is too low for income tax. The question is how high do we want to go? And I've been thinking somewhere around 4 to 4.5% is conservative, considering the fact that we're not just talking about this year, we're talking about a long-term projection that's going to look somewhat like this. So if I go in here and I put the income tax at 4.5%, see if I do this right, then that creates pretty substantial surpluses for us going out in the future. But then the question comes back to education and public safety. And what is a reasonable rate of growth for us to assume for public safety? And, or excuse me, for education. Because that is, I think what we've learned from past discussions about this is that, and let me show you on the summary page here, education, not including the teacher pension. So the teacher pension I did separately, grows here from a budget of $485 million to $499 million, not including the teacher pension, which is another $15 million on top of this. So this would be $415 million. Do you remember off the top of your head what the current superintendent's request is for?
No way.
Yeah, Frank?
Well, just for that's the county share.
That's the county share.
It's in that, it's around 499.
Well, you're in the midst of your budget deliberations
but I mean,
right now.
the request
I think
is-
the request is right around there.
Yeah, the request is right around there. I'd say,
But of course, if you want to talk a little bit about your request and the issues that you're facing.
where do you want to start? I mean, the bottom line, I mean, it shouldn't be bottom line, but I mean, let's remember, much like other areas of county government, it was 80%, Ken, 80% of our budget is people.
That's right.
And,
Yeah.
if you adopt some reasonable compensation scale, just, you can't stay even. And if you're increasing at 3% a year, and you're trying to give a 3% a year increase over time, it's not going to work from the standpoint of, well, then what are you going to do with the programs? So I mean, it's kind of the trade-off we always make. People have the citizens essentially agree with us that we want a world-class school system. And that's not going to come just by increasing teacher salaries. It's going to come by programmatic, structured, strategic, programmatic changes that help us keep pace with what has to happen in education today. It's going to be a lot of different. It's technology, it's programs. What have you done new, and how are you going to afford them?
And I would just also remind that, when we say 3%, given the growth that we're seeing in Route 1 and some of the other areas, we're looking at that much enrollment increase. So we're having to increase, if we're going to keep our class size ratios the same and some of the other things that we're accustomed to, a lot of that is going to be directed just purely to the growth of enrollment. Never mind all that other stuff to crank it up.
I think the rising economic tide is going to include substantial migration back into the county. And I think this has always been cyclical, and I think we're in the early stages of what could be substantial.
Steve, did you want to make a comment?
Well, when you were doing your presentation, was there about 4% capacity right now in the school system?
Overall, but it's
Dispersed all over the place.
Right.
But within that, the ranges are,
Yeah.
we have some schools that are barely at 65% capacity, and the others are 120, 125.
So at some level, we need to recognize that the growth in personal income also is a driver here. We're looking at reduced housing stock over time, we're looking at growth in jobs, we're looking at growth in income, which very likely increases the cost of goods and services in the county. That's going to be a driver, and frankly, you're right, technology is part of this, but salary increases are also part of it. We almost have to tag the increase in education and relate it to the increase in income, if you will.
So do you want to, let's take this, let's put education at 4.5% and see what the impact is on our model.
Well, if you're just bumping the income tax growth rate up.
When I bumped the income tax up
Bump that
to,
up, now you gotta take the other side, you're gonna take it down, so it should see, it's not, it shouldn't net out, but it should be interesting.
Based on that, Richard, one quick question for you. The 6% that you were projecting in growth, how much of that is associated with in-migration? Or is that just existing growth from, is that not included?
That would include some of it within migration based on the historic trends. So it would be no, it was based on trends over the last 10 years, so which is consistent with.
So assuming that growth in the job base at the same time.
And resident base, and it wouldn't be a return to what we had 20 years ago when we had many more housing units, so it's based more on more recent figures.
May I ask a couple questions?
Sure.
First, I'd like to know what the administrative to teacher ratio is for our school system. And I'd like to know how that stacks up to other school systems in the country.
How are you defining administrative?
How many non-teaching positions do you have divided?
Talk about in the sort of general gauge, for example, of central office staff versus.
Yeah, I want to know how
we're at the-
administrative
we're at the
ratio.
It's
extremely
much lower
lean
than-
end of the.
I'd like to see what that percentage is. I'd like to
Yeah,
know that.
that's-
okay, I think you guys can get that for us, can't
I'd
you?
like to know that. And then I'd like to know what other comparable systems.
Well, you know, I think
stack up.
those are important facts, but I think you have to understand that, as I said earlier, we're number one when it comes to education effort in the state. We're spending more as a measure of our wealth than any other county in the state right now. And I think you can make the case that it's been reflected in test scores and in perception. The real estate people will tell you that schools are what drive their real estate market. So what this says is if we continue to authorize $120 million worth of bonds a year, which is what I think we ended up at $118 million last year in the capital budget, and we grow education by this is education not including growth in teacher pension, which is also growing by about 20% a year, that we go negative in 2018 with growing deficits.
Is that with 4.5%?
That's with 4 or 5% growth in education.
And your bond interest rate, Ray, is,
A 3.75.
we'll be selling bonds in the next 2 weeks. We're modeling right now at 235.
Okay.
But, you know, even if you said 3%.
Okay, I'll say 3% for education.
No, for bond.
For bond interest.
Bond, I'm sorry, bond interest, I'm sorry, yeah. I think that's what I have here. Let me just double check. Okay, bond interest rate, 3%.
So the other question I had was, all the unfunded pension liability, how's all this factored in? And where do we stand on that?
Well, I would tell you that we are funding the pension at the rate recommended by our actuary. So we're funding what's known as the ARC. And under that scenario, the Howard County pension systems, which I talked about, are the employee pension is now about 90% funded, and the public safety pension is about 75% funded, should reach full funding within a 20-year period. I will show you that for our assumptions about the teacher pension, we did two things.
Right?
Yeah.
On the pension, I would also add, I think the general employee is about 85%.
Oh, it's 85%. Yeah, it's down slightly, but because we went to a more, I'm sorry, go ahead.
Yeah, and I was just going to mention that about 2 weeks ago, the rating agencies, we presented that information to them, and they basically said that they were well-funded programs. They didn't have any concerns on those funding levels.
Now, I would point out that in our assumptions, in an attempt to be conservative, we increased, and if you notice, we did include the teacher pension number separate from education, and it jumps in 2017 from $17 million to $24 million, which is when we're paying 50% of the so-called normal cost, and the state originally was projecting that would be $17.5 million, and now they're projecting it's going to be $24
That's when
million.
the state pushed it onto us.
Yeah,
Right.
and with regard to OPEB, I have us going, in the 14 budget, we funded $5 million above our pay-go cost, and then growing by $5 million a year. So by 2019, we're putting in $30 million above our pay-go cost for OPEB, which should bring us close to the ARC, the annual required contribution. So I think the thing you have to deal with is, for the foreseeable future, we will have deficits in our health insurance fund, our retiree health insurance funds, and our pensions funds. But that's not a bad thing, because we're moving expeditiously to a point where we're funding them on an ongoing basis. The question is, are we having to sacrifice ongoing services in order to fund those pension costs? And that's where I think our strong personal income and strong income tax gives us the strength to fund these things that we have to fund without compromising our current level of service. I think the question for us, and the other question, which no one from the police is here, but are we satisfied with the current level of police protection? Do we need to increase that level of spending faster? And what is the level of education that's going to grow? And what level of education do we think is an acceptable level of growth?
Can you scroll up to the police budget?
So the question is this is, in our assumptions, this is growing at 3% a year. Is that going to be satisfactory? Because once again, there's two issues that we're dealing with here. The first is, do we have enough police officers? Do we want to increase the number of officers? And I will tell you that police officers are expensive. They have their salaries are increasing. There's a lot of competition in this region for police officers. Police officers move back, have some ability to move back and forth between jurisdictions if at least within the first 10 years of their career. So after about 10 years, they tend to settle into one police department because they've built up seniority.
But it causes incomes to rise quicker than it would if they just stayed.
Yeah, that's true. And their pension, it costs 30% of salary. So
we were Chief McMahon a few weeks ago, and certainly we saw during the event in Columbia Mall, the necessary amount of training that has taken place in recent years, the integration of our police force with other local, state government, local forces. That training commission is only going to increase. The cost of the technology for the department is only going to increase. And Ray, you've indicated even salary costs are going to increase. I think well beyond
it's still going.
We're programming.
keep an eye on it. When it goes out, you can change it. Okay.
So Ray, this data, this projection is based on current level of
Funding.
employees.
Yeah. Well, it's based on the FY14 budget, which is the budget that's been adopted. Oops, I'm sorry. What did I do?
But it's not taking care of this, the projection doesn't take care of the increase in.
Well, it assumes a growth of 3% a year in public safety. If you go back to our assumptions and make the growth in public safety the same as growth in, let me see how let me do it. Make the same growth in public safety the same as the growth in education.
So, I mean, like I can't imagine municipal bonds are going to be in, we didn't actually did that. So
Well, that's Stan's area of
is it
expertise.
realistic to think that in 2017 municipal bonds are going to be at 3%?
I wish we do, but at this point, that's not what we do.
I think that Ed Waddell probably remembers that when we were doing this in 2008 and 2009, we were all saying that by 2014, the inflation would be rampant and the interest rates would be sky high. So who knows? I guess is the best answer to the question.
That's why I'm asking how sensitive it was. That's where I started.
He was at 375, it went down $1 million.
Can you just move it half a point and let us see what it changes? And
Sure.
I'll satisfy myself that I don't.
Ray, on your debt service, does that include the debt service on all the bonds?
All the general obligation bonds paid for by general revenues. We have, for instance, water and sewer is paid for by water and sewer fees, so it's not included in that number.
But does that include all the approved but unissued bonds?
Well, we make an assumption about how many bonds we're going to be selling a year. And our bond sale is scheduled for next month, and we're selling, Nikki, $110 million of, Nikki? Nick? 110 million of general obligation bonds?
Yes.
So we're close, we're getting, I think an issue a few years ago is that our level of expenditures was dramatically, we were building up a giant surplus of unsold bonds. I think we're getting to a point now where there still is a good number of unsold bonds, but it's not as big a problem as it used to be. In that, our bond sales are now approaching the amount of bonds that we're putting in the budget. So, keep an eye on this $2 million number, and what do you want me to change this to?
3.5, I like it.
Okay. Change it $1 million. So I think what we've learned from past years is that because this is spread out over time, the two major factors I think we have to discuss is how many bonds do we want to authorize, and what is the growth rate going to be in education and public safety. Everything else is kind of superfluous. Yeah.
It seems like the entire deficit's caused by the teacher pension issue, or largely caused by the teacher.
Yeah, I would say that's true.
So now
Now
that the state budget is getting better, is there any hope of the state revisiting this?
I would say no.
No, I think this is a very calculated strategy to make the state's budget look better and the county, to put it back on the county's.
But this has got to be.
I think it's a fiction. It really is a fiction, and money in this case is not fungible because they put in some relief in the early and sort of the transfer years, but then it's gone.
It was a revenue increase without increasing revenue for the state.
But Howard County is one of the few places that can probably afford this without having read earlier. 23 or 20-something other jurisdictions have to be bleeding from this. I mean, there's no hope for...
Well, certain of those jurisdictions are probably not as sensitive to reductions in programs in education.
So they're not treating it outside.
I can't speak for any other school board
Well,
member.
I will tell you that...
Elected official in any other jurisdiction, but I mean, this is a big deal, and it was a big deal, and we fought this collectively. There was a lot of, this didn't make sense, doesn't make sense now. All it does is put it on our backs and force us to try to figure out a way to pay for it without any continuing relief from the state.
So, I would point out that all of the big 7 jurisdictions, which make up 80% of the state population, the only county that exceeded the maintenance of effort, or the annual required payment, which is the maintenance of effort plus the increase in state pensions, was Howard County. Montgomery County, Baltimore County, Prince George's County, all of them just funded the minimum that they were required to fund. We funded slightly more than twice what was required of us last year. And now this payment right here, the annual required payment for Howard County for next year, the maintenance of effort plus the teacher pension is about $9.5 million. And so the request from the Board of Education is about $15 million, but that includes no money for salary increases. And a step and a 1% COLA will add about $16 million, or double the size of what they've really requested. Is that a fair statement?
Right, well, the board's official request comes out next week.
Yeah. Now, I would point out, though, that this 4% growth, and this is a little tricky, is without the increase in teacher pension, which is growing at about $2.5 million a year. So that gives you a little more flexibility. So to be really specific, to make this more complicated, the amount requested in education, which is the where do we go here? Don't tell me I lost it. Oh, there it goes. The 455 million. Okay, well, we've upped that to 506 million. That would mean an increase of 400. That would be an increase of about $21 million, plus $2 million in $2.5 million increase in teacher pension this year. About a $25 million increase in funding for education.
Stay tuned.
So I guess the question is are these sustainable going forward? Are we concerned about these deficits in the out years? Or do we think that these levels are generally sustainable in the long term, or have to be dealt with in the long term? Or by growing at 4.5% a year in both public safety and education, are we setting ourselves up for tax increases or service cuts out in the future? And of course then the real question again is how strong is this 4.5% on income tax? If we make that 5%, for example, we push the deficit out a year, but it's still there, but it's dramatic, it's cut in half by 2020.
So, Greg, we're making a guess as to these assumptions in terms of rates of growth and interest rates. But I think the key thing is how are they tied together? If we're looking at the growth in income, how does that affect the growth in spending for teachers, for education, for training, for police, et cetera? And I think what we've done here today is to try to integrate some of those growth rates together so that if we're off on the income, increases in income, hopefully it impacts the cost that we're looking for, the growth numbers that we're looking at for both education and public safety. I think we can't sit here and forecast tactically, but if we can understand those relationships, at least as one increases or decreases, it has a similar effect on the others.
I mean, these are not easy questions because we're, I guess the real question for us to deal with are what are reasonable rates of growth? Are these reasonable rates of growth on both the expenditure side and the revenue side? We can't tell, and we shouldn't be telling elected officials how to spend their money. What we should be guiding them on is what are reasonable projections, what are reasonable levels of spending that are sustainable out into the long term.
This is a quick question. I mean, if we're negative in 2018, if we're that far negative in 2020,
Yeah.
I guess the fundamental question I have is how realistic is that number if Howard County is going to have a deficit driven by the pension liabilities we have?
Yes.
All other counties are going to completely collapse in 15. There's going to be some other. What are the likely answers to those questions? Do they just go? Is it just Detroit?
Well, I mean, that's a really important statewide question that I think whomever is elected governor, lieutenant governor, are going to have to deal with. Is Howard County is struggling to sustain itself with growth of 3 to 4.5%. If Carroll County or Baltimore County, for instance, are showing no increase in enrollment, which means that their maintenance of effort, absent teacher pension, is level, how are they going to sustain themselves as well? I don't know if your friends talk about that in other counties. What's that?
And my question is, are we worried about an eventuality that's never going to happen? And that's, in other words, if everybody else is going to collapse, the state's going to happen, something's going to happen, and it's not going to be $20 million deficit in 19, it's going to be something else. And we can't predict the future. For the folks that have experience in this area, what are the likely outcomes? Is it just they let them go bankrupt? This tax cut didn't help everybody, or does the state only help the people that really need it?
They want the tax
Increase that?
and they blame it on the county.
At the local level? Or
Well, that's the
It's a
answer.
local obligation.
Well, we've assumed no tax increase here. We cannot increase the income tax. We are at the maximum level of our income tax, which is 3.2%. And a 1 penny,
Have room to increase.
Right.
yeah, a 1 penny increase in our,
We get $100 million in additional revenue.
Yeah, so the state will just raise the piggyback rate and say we're doing it because the counties can't, they'll push it, the blame down and raise the piggyback.
just to tell you that 1 penny on our property tax rate generates about $4.5 million in revenue. So in 2019, raising the property tax rate from about $1 to about $1.4, $3.50 would wipe out that deficit if we assume 5% growth in income tax.
In the last 2 years,
We've seen higher growth than that, primarily, and I'm anticipating we will see higher growth this year because of the capital gains.
so the surpluses for the last couple of years are more at the end of the year than what was projected at the beginning of the year.
That's right. That's where our surpluses have been coming from. And we've seen, what is it, I guess 7 and 8% growth in income tax over the last 2 years. But I think that's coming off of years where we were level or went down for 3 years in a row.
Assumptions for real property tax increase?
3% I think is reasonable. And even if property values start to increase faster than that, because of the triennial assessment process, they're going to not phase in much faster than that, we could go to 3.5% on, let me see which one this is. We could go to property tax, we could go to 3.5% and see what that looks like.
Real estate values tend to coincide with whatever the rate of inflation is over the long term. So 3% to me is the right number.
Now, going to 3.5%, you know, because property is still 50% of our revenue, that going from 3 to 3.5% essentially wipes out the deficit if you assume a 5% growth in income tax.
Do we have that then?
What's that?
I think the near term, you probably nailed it, Ray, but once we begin seeing growth in property values and assessable base, we still have to get past the homestead tax credit, if you will. After that's absorbed, when you get out into 2020, 2021, et cetera, we will have fully recovered from the drop in housing.
Well, I guess the real question is our residential home values going to grow faster than 3%, or going to grow on an average of 3% a year or faster, or not? Commercial right now is growing at a much faster, and that's pulling our average up to about 3% a year. I don't know what the long-term trend. I'm looking at you, Alan.
I mean, we have data. Just look at the data. Go look. It tracks with inflation. It is what it is.
Okay.
The income, I'm not that well versed at, so I'm curious. We have to have income data and look over some different 10-year periods, slice and dice it. What's been the average income growth in Howard County, and can we extrapolate anything from that? To me, if you start saying everybody's income's going to go up 5% every year, I'm a little uncomfortable with that, quite honestly.
Well, that's the people moving in. It's also new.
Ray, the other question I have is, what was it last year that we projected for education, for example? Or police?
Okay.
Combination
What
of
do you mean by that?
Yeah, I think it was about 4%.
Right.
Yeah. Let me, hold on a minute. Let me,
Right.
That's the total left for both of you together.
Right, for that year.
It's continual growth in population.
Right.
That's why I was asking Richard earlier. It's
got both
a hodgepodge
population.
of both over the history.
But the concern I have is if the Route 1 corridor is what's driving the growth, and that's what it's lower income, you can't, how realistic is that?
okay, this is the income tax. It's a combination of the purple line is growth in income tax. The blue line is percentage change from 2006 through 2013. It doesn't include 2014.
So,
You can see
okay.
it did dip a little bit here. You can see that percentage change of minus 5%, which was pretty dramatic when it occurred. I'm sure you remember those days.
What is that, 08 or 09?
This is 10.
Right.
There's a lag, and FY10 is really pretty much taxes from 9 or 8, and partially 8 and partially 9, which was the depth of the recession.
So 5 looks like you're going to get rid of the recession. The 4.5 to 5 is the range.
I'd also point out that in my experience, capital gains sadly follow capital losses sadly follow capital gains.
Yes.
And the loss carried forward could wipe that out for a while.
Well, that's what occurred here.
Yeah. I just mean, while we're looking at the growth in capital gains, I wouldn't count on that much because it could fall off immediately and it won't come back even after growth until the losses carried forward.
And based on all the discussions we've had about the infrastructure, and especially the aging infrastructure of the county, I don't know that dropping down potential bond purchases in the future might want to do it, but I don't know if it's going to be possible to go.
Well, and I think what we've also seen is that a $10 or $15 million change in bond authorization doesn't have, because the cost is spread out over 20 years, doesn't have a dramatic impact on our expenditure pattern. That was the big revelation, I know, Frank, that we had a couple of years ago, that the minor impact of bonds on the long-term financial health of the county. It has it grows a little bit each year, and we're getting to a point now where about 10% of our budget is going to pay debt service. And I think we feel, and given the infrastructure needs we seem to have, that seems to be a reasonable level. It's really going to be driven by these these three issues: growth in assessable base, growth in personal income, and growth in education, to a lesser extent, growth in public safety. So, I mean, you know, there are no answers here. There are no perfect answers. We deal in the level of uncertainty all the time. I will take the information I got from you today in terms of growth rates in the vicinity of 5% and 4.5%, and I will draft a report for your review. I'll try to get that out next week to everybody for your review so that we can try to meet our deadlines. Is there anybody, any words of wisdom for me?
Be conservative.
Well, and again, I think it is important to be conservative because there's no upside to being too aggressive, I guess it's not about. I think the word conservative and liberal are pejorative words. I like the word to be prudent and aggressive. and you can be both a conservative and a liberal, and you can be both too prudent and too aggressive in your projections. And I think that's really the issue for us here, is striking a balance. I'm sorry.
Be realistic, grounded by data that you can look at.
Yeah.
That's what I think.
Well, I want to thank you very much for all the time you've spent with us these last month and a half almost, and I will try to get a draft report out to you, and again, hopefully our battery lasted this time, so we'll see it. And I want to thank you all very much for your participation this year, and I'll be sending out a draft report. I probably won't use the Dropbox for the draft report because as you make changes and reload them up to the Dropbox, it would get too complicated. So I'll email the report to you and ask you to make changes on that or edit comments and then email them back to me rather than using the Dropbox for that, because it would just be too confusing with everybody changing everybody else's document. So thank you very much, and I'll hope to see you again soon.
Make it happen. Thank you, Richard, for your presentation.
Okay.